네, 월가 트레이더 버니의 미국 주식 시간으로 넘어왔습니다. 오늘 또 이야기를 해주실 내용을 살짝 보면요. 투자는 심리전이라고들 하죠. 저는 그 심리전에서 늘 밀리기 때문에 주식시장에서 수익이 좋지 않은 편인데 관련돼서 이 시장에서 살아남을 수 있는 심리를 좀 다스리는 방법 오늘은 준비를 해주셨다고 하니까요. 현재 계시는 월가 트레이더 버니 씨와 함께 연결을 좀 해보도록 하겠습니다. 준비해 주신 내용 함께 보시죠.
So let's step back now and revisit, because it's such an important piece of the market, market sentiment, generally speaking. And we'll look at consumer sentiment a little bit in terms of how consumers view the economy. But don't forget the three things that identify, because we're not obviously in an uptrend. So the three things that identify tradable bottoms, and tradable bottoms can be great price appreciation opportunities on a really quick basis, and provide long-term holding periods where you can enter trades enter and purchase stocks at really great levels, is that you've got a preponderance of stocks that are trading below their moving averages, not just some stocks, but a preponderance. So a great number of stocks, a degree of negative sentiment, which is what we're going to look at right now, and then a complete lack of liquidity in the markets where the bids and offers are really far apart because the volatility in the market is so great. High volatilities tie out the low stock prices. So let's take a look right here. So we've done this before. We've looked at it again and again, and we just continue to look at it. It's the American Association of Individual Investors, okay? They come out every week and they say, are you bullish, are you neutral, are you bearish? And the number of people that are bullish, and subtract that from the number of people that are bearish, okay? If there's more people bullish, we're going to be positive. If there's more people bearish, we're going to be negative. Okay, so what we have right now is here's the low that we set in 2013, and you can see that that was in an uptrend in the markets. Okay, we also hit our low back in 2010 in the stock market, and then we've had other identifiable lows, basically 2015-16, end of 2018, and then 2020 with COVID. And we're back down into here again. So we're at the lowest level we've been in 10 years, okay? That's great. That's one chart, okay? It's one component, and it's one piece of one component. But it's good. It tells us that there's a lot of negative sentiment in the market, and that's what we want to see if we want to look for buying. Let's look at another a measure of stock market sentiment. And this is the Investors Intelligence reading, okay? And this takes the bulls divided by the bears, okay? So we can go over 3-to-1, or we can be 1-to-1, okay? At 1-to-1, that means that when we're below 1-to-1 in this survey, we're able to say that there are more bears than bulls, okay? More people anticipating the market going down than anticipating the market going higher. The light blue lines, the vertical light blue shaded lines, are periods of time when the stock market goes down. So you can see as the stock market goes down, and then we get into these negative sentiments, then that light blue line goes away and the market starts to go higher, okay? But they come from levels that are below 1, okay? The pink shaded lines are periods where we're in a recession. Well, when we're in a recession, clearly what we have, okay, is most likely we have the stock market kind of working its way lower. But sometimes the stock market, once the recession starts, the stock market bottoms and is looking forward. It all depends on how long that recession may be. I believe that this recession, if we have one, and I don't know if we will or we won't, but if we have one, it's not going to be that long. I don't believe the Fed has any temerity in terms of being able to withstand the heat on politically that they'll have if we start to go into recession and they continue to raise rates. I just don't see that happening. So all these occurrences here, these green vertical lines, are when we have more bears than bulls. And you can see that in the process of almost all of these, with the exception of this one, which took a longer amount of time, is that, and this was 2007, 2008, when we had all that mortgage problem that we had, and Bear Stearns declared bankruptcy and Lehman declared bankruptcy. Other than that, these have been great opportunities to be able to buy the market. So, and if you hold the market for 1 or 2 years later, you're going to be a winner in all of these occurrences. Even if you did this, as long as you didn't do it at the beginning, theoretically, great. But this is still only one component, and we want to think about that from just the fact that it's one component. But it's a great indicator that people, when they get too bearish, the market doesn't follow through. It then starts to go the other way. That's why it's one of our 3 things that we think about all the time. Now, we've looked at stock market sentiment. Let's also look at consumer sentiment and how they view the economy, okay? All the vertical gray lines are recessions. And what we have sometimes is we have declining sentiment without a recession. But every significant move down here has correlated to recession. And I keep saying I don't know if we're going to have it or not. It's not my job to be able to try and identify whether we're going to have a recession or not. It's my job to be able to identify being able to make money trading stocks, okay? So we don't have to get the whole economy right, but we have to understand how people perceive the economy, okay? And what happens when they perceive it. Because just because you're in a recession, that may be the perfect time to buy the stock, or you may have to wait until that recession deepens a little bit, if it's a longer-term recession, before you can buy. So you're just thinking about things. The job we have is to try and be able to buy stocks and have them go higher. That's the job we do. So we don't try and guess whether we're going to get into a recession. We leave that to people that have no clue, and that's what they do for a living. Anyway, what I do know, though, is that when we get down here, we get into places where we've had a recession before, where we get into that little turquoise line. Okay, fine. I'm not saying because we've done this 15 times in a row that we're going to do it the 16th time, but I'm mentally prepared for that. And what I want to say is, if the individual in the economy thinks that we're going into a recession, what is he doing about it? What is happening to him? Because those are the driving factors. Now, one of the things that we had is we had a significant sell-off after COVID. Okay, a lot of people said, oh my gosh, okay, my outlook on the economy out 1 year is terrible. And they had all the reason in the world to think that, because that was a whole surprise to us. We didn't know how to treat it. We didn't know if we had cures, not cures, whatever. Then we had a bounce going into the second half of 2021. And now that the Fed has decided to take the liquidity away, and we've had Russia invading Ukraine, which is impacting both the price of energy and the price of food, we're starting to see another significant decline in this thing. So will we go into recession? Let's see. But maybe for sure. But I'm not saying, I'm just saying I'm trying to identify market bottoms. Here's another measure of consumer sentiment. This is the small business, United States small business consumer confidence level. And what I've identified here are not only all these gray lines are basically back to the recessions again, and we can see that we would anticipate that we would be in a recession, but March of 2009 was a bottom. September of 2001 was a bottom, but we kind of penetrated that a little deeper later. October of 90 was a great place to purchase stocks. March of 82 was a tremendous place to purchase stocks. April of 80, we bottomed. The market went lower in March of 82 than it did in April of 80. But these levels were substantially attractive. The level of interest rates were so high. In April of 80, we had gotten to 15-16% mortgage rates. We had gotten to 20% funds rates. Basically, we were a significant level of short-term and long-term interest rates, which is a difficult headwind for the stock market to compete against. But if you hit the price of stocks cheap enough, then it can compete against anything. So you just had to identify down there times that the market was basically cheap enough to buy. And once interest rates started going down, and they started going down in 1981, they stopped going higher, and then they went down, and then they kind of topped out in the fourth quarter of 83 and started going lower again after that. And they went from 16% to, in March of 86, they were at 7%. So lower levels of interest rates are really a good positive driving force for the stock market. And what we want to see right here is we'd like to see this, as we talked about it before, as this goes down, it's difficult for stocks to rally. But as it goes up, it's great. So we just want to find occurrences where we think that can stabilize. We can't necessarily project that it's going to go higher. That's too difficult to deal. But if we can project, hey, this is low enough in here that I think the chances are better that it goes higher than lower, that's what we want to look for.